Proud supporters of Africa this week. Engine, with us, you are number one.
More than 1 in 2 institutional investors see Africa as the most attractive region to invest in the next decade, with 1 in 3 expecting to put at least 5% of their portfolios into the continent by 2016. We spoke to Sharif Salim in Abu Dhabi. He is the portfolio manager for Invest AD Emerging Africa Fund, who commissioned the poll from the Economist Intelligence Unit.
Invest AD's perspective, we've been very bullish on Africa. We invest in the Middle East and Africa, but we've had, as you said, the Emerging Africa Fund for some years now. From the perspective of those interviewed, there were about 160 fund managers that manage pension funds, as well as some of the asset management and mutual funds. The most that drew investors was the story of income convergence. Now, a lot of people realize that Africa is rich in natural resources, but it's the growth of the middle class and the potential demand that is generating, which they're most attracted to.
Okay, let's understand the concept of income convergence, because from the report, many analysts believe that we're going to start seeing incomes rise in Africa compared to what we're seeing in Asia, and that when you look at the rise of the African middle class, it's starting to look like a consumer with purchasing power, much like the Asian in India and in China. Personally, I don't believe those statistics, because we do have a rising middle class, but the people still living on the breadline outweigh this middle class.
Yeah, well, for Africa and for this study in particular, the middle class, how we describe the middle class, or how it's described within this report, is anywhere between $2 to $200 per day. Per day in terms of income. So it's a bit different in terms of equating a middle class with Africa with other parts of the region. Having said that, it's still in terms of disposable income, it's expected by the year 2020 that will be up to $1.4 trillion in disposable income. So there is an increase in incomes for Africans.
We also looked at a new long-term survey on investment in 3 African economies, Kenya, Ghana and Nigeria, and we discussed their growth prospects with Edward Cropley from Reuters, who conducted this survey.
Zimbabwe, of course, is in sort of massive arrears to the IMF and World Bank and other multilateral lenders. So there is a chronic dollar shortage in the country, which is hampering any sort of broad-based economic growth, which is interesting to see, of course, why Finance Minister Beattie yesterday said they were having to bolster their budget with these extra IMF funds. But yeah, I mean, if you're an equity investor, Zimbabwe has always been an attractive stock market. It's a fairly diversified set of holdings, from beer companies to telecoms to mining companies, of course. And if Zimbabwe can get its sort of the political machinations sorted out, and there are, of course, huge question marks over the current government and what's going to happen with an election and a new constitution probably this year. If that is sorted out, and as I say, it's a big if, then the economy really should grow very fast.
But according to the Reuters survey, it's Ghana that's the star performer. Is it the oil story?
There is a big oil story in Ghana, obviously, although the recent fluctuations in the currency, and I say fluctuations, I mean in the last sort of 2 weeks, the currency has fallen sort of 7 or 8% against the dollar. There are various reasons behind this, one of which is maybe a lack of sort of a disappointment at the amount of oil revenues that are coming on shore. Although we've known for some time that output in the early months of production hasn't been quite what it should have been. Similarly, there have also been concerns about possibly the central bank not being sort of as interventionist in supplying dollars as it could be. But you know, the outlook is looking bright for Ghana as long as it can control what will be a large influx of petrodollars in the next few years.
Let's talk about the first two, though, because clearly there is convergence in this survey and that. Nigeria and Kenya. I mean, Nigeria, the usual suspect. 160 million people. It's a critical mass. There's a huge potential for the Nigerian middle class to drive retail. And that's really the trend that we're starting to see in Nigeria, is the growth of the non-oil sector. What else works in their favor?
Well, Well, that's exactly it. The two big things everybody knows about Nigeria is it's the most populous nation in Africa, and it's also the biggest oil producer. But the interesting thing from all the economists that we spoke to as this part of our long-term polling is that it's the non-oil sector that's going to be driving the growth. That's the retailers, the shopping malls that are going up in Lagos and Abuja and some of the other cities. It's the telecoms companies which are signing up new subscribers. And some millions of people every month get mobile phone subscriptions in Nigeria. And of course it's the banks, which are sort of putting the crisis of 2008 and 2009 behind them, thanks indeed to the very astute and rigorous intervention by the authorities from Abuja.
But how come the reality on the ground doesn't reflect that? We talk about these reforms, we talk about the stellar growth, and then you look at the performance of the Nigeria Stock Exchange, you look at inflows by way of government bonds, and investors are not flooding into Nigeria.
Well, it has to be said, I would take exception to some of the findings of the survey from the previous caller. If you take the long-term equity horizon from Africa, Nigeria's been a dog, Kenya's been a dog. Really in sort of local currency terms, you've got flat returns, and if you put them into dollar terms, where the currencies depreciate against the dollar, then you've actually taken quite a hit over your five-year time horizon. Which, given that these economies are meant to be growing at 5, 6, 7% a year, you're thinking, well, where's this growth gone? And the challenge for investors is to translate this big macroeconomic growth into real returns that they can take home in dollars, and that is not easy still.
Nigeria Electricity Regulatory Commission has announced that electricity tariffs would be going up by between 50 and 100% by February. The new tariff is expected to be effective from the second quarter of this year. Sam Amadi, Executive Chairman of the Nigeria Electricity Regulatory Commission, spoke to us about the reform in Nigeria's power sector.
This in the tariff would be based on consumer classes. Some consumer 50%, some will have less than that, and then some will have a larger percentage. For example, the residential class 1, essentially rural dwellers and those who consume minimally, would have quite reduced change in their tariff. But we expect that commercial class and some high consumer in residential areas will pay quite more. So we want to base it on how much it costs to serve each consumer classes.
Okay, how does that reflect in the pricing? Newspapers suggest that for those on the higher spectrum, on the higher end, who have been paying about 15 naira per kilowatt, are now going to be paying about 23. So in terms of bills for businesses and richer middle-class citizens, what does that mean each month?
Well, it depends on what they consume. First, let me say, right now we have an average tariff of 10 naira. But if you use the average tariff, it could come to 23 naira thereabout. We are still optimizing the assets, so there's some hope that the price, before it's announced, could go down by 1 or 2 naira. But essentially, what it means is that the cost will be, the tariff will be cost reflective. And so we hope that there will be consumption that is more conservative. People will use energy saving bulbs and devices, and therefore their bills might not be as high as it would have been. But essentially we want to make sure that those who invest in the sector recover their costs so that they can expand access and improve service.
Kenya is renowned for its tea, but last year the commodity has surpassed all previous export records. The country's tea earnings rose 12.4% in 2011, maintaining its position as the country's biggest foreign earner. Our team in Nairobi attended the press briefing highlighting Kenya's tea performance and filed this report.
Tea exports climbed 12.4% to a record 109 billion Kenyan shillings last year. That's according to figures released by the Agriculture Ministry. During the period, the average price of Kenyan tea edged up to $2.99 a kilogram from $2.75 in 2010. This, coupled with the weak shilling, which lost more than a quarter of its value against the dollar in October, gave support to the tea sector in 2011.
2010, we had earnings of about 97 billion of foreign earnings on tea. This year we are talking of earnings of 109 billion in foreign earnings from a volume of 377 million kilos. The cumulative local tea consumption stood at 20 million kilos, valued at 11 billion. The tea sector performance surmounted the production challenges occasioned by hot and dry conditions in 2011.
Tea production, however, fell 5% to 377 million kilograms compared to 399 million kgs recorded in the previous period, when it earned 97 billion shillings from the crop. This amid one of the region's worst droughts in 60 years. Earnings from the local consumption, meanwhile, grew to 11 million Kenyan shillings as the Tea Board continued its promotional campaign to encourage domestic consumption. This still lags total tea exports by 5%.
The way Kenyans consume tea traditionally doesn't actually help us in pushing grammage of tea, because half the cup will be milk, a third of it will be sugar, and the rest of it very little tea. If you go to countries with the developed tea drinking cultures like Russia and China, actually there is no milk in it, there is no sugar in it, so the grammage of tea in a cup is a lot higher, and therefore the per capita consumption is a lot higher. So that goes to a tradition and the way we have been handling or consuming tea.
Kenya, which is the world's largest exporter of black tea and employs more than 3 million people, has over the years relied heavily on a few traditional markets such as Europe and the US as its key trading partners. But the country is actively targeting emerging markets going forward.
Kenya tea exports have been increasing in the last 5 years. For example, export to Russia grew by 44% from 12.2 million kilos recorded in 2007 to 17.4 million kilos in 2011. Over the same period, export to United Arab Emirates grew by 64% from 13.7 million kilos to 22.6 million kilos, while export to China grew by 68%.
And despite the current hot and dry weather conditions in the country, the Kenyan government expects tea earnings to hit 115 billion Kenyan shillings this year, surpassing last year's record.